What up, Hyperchange? Welcome to a new episode. This is going to be a follow-up video about the debunking Jim Chanos short thesis episode I made about a week ago. A ton of amazing feedback on that episode, so thank you so much. So I've been thinking a ton about why Jim Chanos is really short Tesla. It seems very unlike all of the other companies he's shorted in the past, and I think I sort of had a breakthrough in terms of what is so unique about Tesla that is attracting a lot of short sellers. And just in a broader sense, I think this is a really interesting sort of financial theory to discuss. So if you're not a finance nerd, maybe this episode will be boring, but if you're into the Tesla short thesis and debate, this is going to be epic. So I spent long and hard thinking about this new term that I sort of made up called perceived solvency. So perceived solvency is a key fundamental aspect of a business that I think short sellers like Jim Chanos love to target, and it actually makes a ton of sense. So now, what is perceived solvency, and why is this such an important crux of the business models that short sellers like to short? The theory here is that companies like Tesla are constantly relying on the capital markets to fund their business model, i.e. they're burning more money than they are producing. That means they need to have money coming in some way to the company, whether that's raising debt or selling stock in the form of equity to raise that money doesn't really matter. But the point is they are reliant on the capital markets to fund their business model, and they need to have a low enough cost of capital to make their business model work. And why this is such a fascinating concept, and I think such a brilliant short selling strategy, is that a change in the public's perception of the solvency of that firm could actually impact the real solvency of that firm. Now, let me explain. Let's say people start to get very hesitant about Tesla's future and they start to lose confidence in the company. It looks less stable. Well, then the cost of raising debt will go up because the company's solvency looks weaker. Therefore, Tesla's paying a higher interest rate on the money it borrows, squeezing its own margins, making its business model look worse, potentially leading to even higher interest rates on the next raise, and there you go. And this can be sort of a death spiral effect for companies who are reliant on outside funding, and then when that funding dries up, they have to raise capital on more and more desperate terms, raising their cost of capital, breaking their business model. So for instance, Jim Chanos was short SolarCity prior to its acquisition by Tesla, and one of the key theses for SolarCity is they were reliant on massive outside capital to be able to get money up front to fund these leases that they were giving to customers, and therefore they were heavily reliant on a public perception of solvency to be able to raise capital at a low enough rate to actually be able to make a profit when they leased out these solar systems. And as you can tell, if this is their cost of capital and this is what they're bringing in, this space is their margin. So as their cost of capital goes up, their margin gets squeezed, and eventually if their cost of capital goes above their return because the perceived solvency is so bad, the business model will be broken. So how does this relate to Tesla? Up until now, they have been reliant on the equity markets and debt markets to constantly raise hundreds of millions or billions of dollars of capital to fund their growth and expansion. In the mind of a short seller like Chanos, the second these capital markets dry up, Tesla's not going to be able to have that cash infusion, which in his opinion, the company is reliant on, and they will absolutely crumble. So if the perceived solvency of Tesla changes, then that could actually structurally change the business model of Tesla. Now, this gets us to the very interesting point of how reliant is actually Tesla on perceived solvency, because this is where I actually disagree with Jim Chanos, and why I think although the theory makes a ton of sense on paper, Tesla is not going to actually be a profitable short selling trade for that theory, because I don't really think they're as reliant on perceived solvency as you might think. The reason being is Tesla burns hundreds and hundreds of millions per quarter, but the bulk of that money is capital investments to build out infrastructure to expand the company. In a worst case scenario that would change the perceived solvency, let's say something like a massive Great Recession or some massive product recall that instills fear into Tesla's future, well, in that scenario, I believe Tesla could dramatically curb spending on its capital investments, reducing its needs for outside capital, and therefore Tesla isn't as reliant on this notion of perceived solvency as you might think. But on a broader note, I think Chanos actually makes a really, really smart point here, which is that the capital markets in perpetuity, this is just how the world works, they will close from time to time. And if your business model needs to raise capital or equity constantly from the capital markets. It's almost inevitable that you will fail because it's almost inevitable that these capital markets will close. And so this is the sort of logic and rationale of why I think Jim Chanos' short selling strategy is so brilliant and so fascinating, and why he has one of the best track records on the street is because he really understands this notion of perceived solvency. Now, there's been a ton of people emailing me about this post on the Tesla Motors forum describing a company called Fairfax that previous short sellers were involved in. I think some of the people involved in that are involved in Tesla. I kind of think that it's a conspiracy theory. Frankly, I don't actually believe there is people that are trying to manipulate the price of Tesla or, put stories in the press to change the perception of solvency. But I will say that the incentives for a short seller betting on perceived solvency align to changing that perceived solvency in any way you can. Whether you're actually going to try and do that is a different question, but the incentives are aligned there. This is a really interesting theory that I think, makes a ton of sense and is really important to illustrate in the financial markets. This is why Amazon is far different than Tesla at its stage in its business model, because Amazon is not reliant on perceived solvency. They can fund all of their CapEx needs with internal cash flow from their business, so they're not reliant on an outside funding source. Right now, Tesla is still reliant on an outside funding source to grow and expand and to just keep the lights on for its business. So that is why it is so important and critical for Tesla to be able to produce positive operating cash flow as the Model 3 ramps like they promised in Q3 and Q4 of this year. Because if they can do that, it will dispel all rumors that they are reliant on perceived solvency, because instead of being reliant on that, they will be reliant on their internal cash flow. And that is a much stronger position as a company. And that is why I'm so excited about the next 6 months or so for Tesla, because the biggest pillar of the short thesis, the fact that Tesla gets lumped in this bucket of perceived solvency, is a very valid reason of the short thesis. And until Tesla proves that they can be profitable, that will be valid. And something that really opened my eyes to this, shout out to Rob at the Tesla Daily Podcast, who's one of my favorite Tesla content creators. He had an amazing interview talking about short sellers and Tesla, and he mentioned something about Chanos that has really stuck with me, which is that he's not an auto analyst. He's not a technology analyst. Or why would he seemingly get involved in a company like Tesla, which is so out of his traditional realm of expertise? Well, because it's not about the car industry. It's not about technology. It's about the company's fiscal engineering strategy of relying on perceived solvency to run its business, which frankly is a massive Achilles heel. And it's not something like, I'm like, oh crap, Tesla's screwed. The entire financial system relies on perceived solvency, which is another reason I wanted to make this episode. The way that banks work is something called fractional reserve lending. Banks, for every $1 in capital they have, can lend out $10. And this is where the term run on the bank comes from. If everybody tries to withdraw their money from the bank and they've given out $10, but they only have $1 in their actual account, then you sort of had this insolvency issue where the bank can't pay out everyone who put in money because the money's simply not there. So even the world's largest financial institutions, and frankly, the entire, financial complex that runs society today, is based on this notion of perceived solvency. So that is why I think it's such a fascinating point to illustrate. I hope this makes sense. I would love to start a, continued discussion in the comments below. So please, share your thoughts, ideas, feedback. Anyway, this is Hyperchange. If you'd like to support the channel and the show, check out our Patreon page. We have an exclusive premium newsletter that goes out once a week that I think is fire. So definitely check that out. And for those actually wondering, is Chanos actually planning on debating me? I called him out in my last video, wanting to do a live debate on Cheddar, Bull Bear. I thought that would be so much fun and so interesting. Twitter account that is called Diogenes, which is apparently supposedly operated by Chanos. I tweeted at it and he replied saying he would actually be willing to do a debate, but only if a Tesla C-suite member is present. I personally think this is sort of him copying out because, of course, Tesla's C-suite does not have time for this. I frankly don't think they should waste their time moderating a debate, and I don't think they need to moderate a debate. If it's streamed live, there's this thing called the internet and Google, which is there for fact checking, so I don't think it makes sense to require a Tesla executive there. So Chanos sort of wimped out. I can't blame him, though, because him debating me on live TV is sort of a lose-lose proposition for him. Either we go on there and I make him look really bad because I correctly articulate the bull thesis and refute all of his points, then that's not going to be good for his career. And if he makes me look bad, well, he's 20 years older than me. He's worth hundreds of millions of dollars. He's one of the most respected people on Wall Street. Of course, he destroyed me. So there's no upside for Chanos to really do this debate. I am a little bit bummed that he did wimp out, but that sort of is what it is. I can't, I see where he's coming from. But that being said, Chanos, if you're watching and you're still down to the debate, please let me know. Anyway, I'll see you guys next time. Peace.